demand. What is meant by demand? We have seen the importance of demand. So the production depends mainly on the demand for the product. Production schedules are planned basing on the demand. So let us see what is the meaning, simple meaning of the word demand. Demand means the number of units of a commodity that customers are willing to buy at a given price under a given set of conditions. So how much quantity people are willing to purchase given the price and given the other conditions like incomes and price of other commodities, etc. So we have seen the meaning of demand, and now we need to know what is a demand function, what is a demand schedule, demand curve, and the law of demand and exceptions to the law. So what is a demand function? In economics we use several functions like demand function, cost function, production function, etc. Always a dependent variable is a function of independent variable. You have to write the equation as a dependent variable is a function of the independent variable. Let us take the case of demand function. Quantity demanded is a function of own price, incomes of people, prices of related goods and wants. So that is why it is expressed as QD. Quantity demanded is a function of P. P stands for own price, Y income of the people, P subscript R stands for prices of related goods and wants or tastes. That means on the right hand side of the equation they are called independent variables. A change in either of the independent variable, one or other independent variables will cause a change in dependent variable. That means when price increases, quantity decreases. For example, there is inverse relation between price and quantity. And similarly, income, when income increases, quantity also increases. When people's income increase, naturally they purchase more, so the demand for commodity will increase. Coming to the prices of related goods, two types of commodities. One is called complementary items and substitutes. Substitutes are nothing but the alternatives. They replace the commodity. For example, if the price of a commodity increases, less of it is bought, and people instead of this commodity, its alternative will buy. That means the demand for the alternative will increase. So change in the price of one commodity leads to increase in the demand for alternative quantity of the alternative commodity or substitute commodity. In case of complementary items are items that has to be used together. They go together. So when price increases, not only demand for this product decrease, the demand for complementary items also decrease. So there is inverse relation between price and demand for complementary item. So that's how we have to see the relation between each one of independent variable and the dependent variable. Okay. Another simple technique is demand schedule and demand curve. In economics, to explain the relations or to make a proposition or theorems, there are different ways. One is by verbal statement you can explain a relation between two variables, or you can have a numerical example, or you can present in a graphical form. So this is equation form. We have seen what is a demand function to explain the relation between independent variables and dependent variable. For example, if price quantity relations are shown in the form of a table, that is called demand schedule. What is a demand schedule? Demand schedule is a list of prices and quantities, and the list is so arranged that at each price the corresponding amount is the quantity purchased at that price. You have to see that at each price the amount is shown against that is the quantity bought. And if the same data is converted into a graph, that becomes demand curve. So what is demand schedule, demand function, demand schedule, demand curve? They all explain the relation between independent variables and dependent variables. Then coming to what is the law of demand? Law of demand states the inverse relation between price and quantity. Generally speaking, there is inverse relation between price and quantity. If price increases, quantity decreases. If price decreases, quantity increases. That inverse relation we call it as the law of demand. So are there any exceptions to this general law? Yes, there are certain exceptions. There are three known exceptions. One is known as the Giffen's paradox, and second one is Thorasian Veblen's doctrine of conspicuous consumption and price expectations by the consumers. Let us discuss these three in brief. Let us see the Giffen's paradox. Sir Robert Giffen, he has studied the expenditure patterns of low-paid British wage earners. These low-paid British wage earners, they subsisted on a diet mainly consisting of bread and meat. When the price of bread increased, they consumed less of meat and increased the consumption of bread. So according to law of demand, we know that when price of bread increases, quantity of consumption of bread must decline. But here what happened is, they increased the consumption of bread and instead they reduced the meat consumption to compensate for the total caloric intake. So that is a clear exception to the rule. Second one is Thorsten Veblen and his doctrine of conspicuous consumption. It is also a universal human experience that rich people, for example, they purchase certain items as when they consider it as a status symbol. When the price of certain items like gold, silver or diamonds are very high, they consider it as a status symbol and they buy. And when the price of such items decline, they may not be willing to buy because they are no more status symbols. That is called Thorsten Veblen's doctrine of conspicuous consumption. So they measure the desirability of commodity only on the basis of price and nothing else influences their purchasing behavior. And when price declines, they may not increase their consumption. And last one is price expectations of individual consumers. For example, imagine the price of gasoline has increased. If people anticipate further increase, naturally at higher prices they try to buy more. And similarly, when price declines, when they anticipate further decline in the price, they will wait for some more time and they will not increase their expenditure. So this is about demand in general, what is the meaning of demand and the concepts of demand and law of demand, exceptions to the law of demand. And another important topic which is relevant to microeconomics and also to managerial economics is elasticity. The law of demand only says that when price declines, quantity increases, or when price increases, quantity declines. Imagine price declines by 50%. Whether quantity increases by exactly 50% or more than 50% or less than 50%. What is the responsiveness of quantity to a given change in price? That is the concept of elasticity. So a manager is interested in knowing the reactions of the customers. For example, if he increases the price by 10%, how customers react? Whether they reduce their consumption by exactly 10% or less than 10% or more than 10%. So he is interested in knowing the elasticity, price elasticity. So there are numerous concepts of elasticity like price elasticity, income elasticity, cross elasticity, elasticity of substitution, supply elasticity. So always, if you know the general concept, you can apply the concept to any relations, any relation between any two variables. So what is the general concept of elasticity? Elasticity is a measure of responsiveness. Basically, it's a measure of responsiveness and it is calculated, it is a ratio of percentage change in dependent variable by percentage change in independent variable. That is, on the numerator you have to write dependent variable, percentage change in dependent variable, and in the denominator you write percentage change in independent variable. For example, take the case of price elasticity. The formula for calculating price elasticity is percentage change in quantity divided by percentage change in price. That gives you price elasticity. If you relate quantity and income, you are calculating income elasticity. Instead, if you relate quantity of A commodity and price of B commodity, you are calculating cross elasticity. So these are different concepts of elasticity. So by applying to two variables, you can calculate any type of elasticity. So among the elasticity concepts, most important one is price elasticity. Based on the value of the coefficient, you can classify price elasticity into 5 types. That is, if the value of coefficient is greater than 1, we call it as demand is elastic. If it is less than 1, demand is said to be inelastic. And if it is equal to 1, demand is said to be unit elastic. These are the three cases, and the two more extreme cases are if demand is perfectly elastic, that is if the value of coefficient is infinity, that is called perfectly elastic, and if the value of coefficient is 0, demand is said to be perfectly inelastic. So what is the relation between elasticity and expenditure? This is also very important to a manager. For example, when demand is elastic, here you can see the table. When demand is elastic, a reduction in price brings more revenue to the seller. For example, by reducing price from 10 to 9 or 9 to 8, you can see for PQ is nothing but expenditure from consumer's point of view or revenue from seller's point of view. You can see when price declines, the total revenue increases in case of elastic demand and decreases in case of inelastic demand and remains same in case of unit elastic demand. So this is also very much useful to a manager because he should know the effect of price change. If he wants to reduce the price or increase the price, how it is going to affect the expenditure to the consumer or revenue to the firm. And then how to measure elasticity. There are two types of measurement. One is called point elasticity method and second one is called arc elasticity method. And what are the determinants of elasticity? Why the demand for certain commodities is elastic and why the demand for certain other commodities is inelastic. The determinants are, there are three important determinants. One is the number and closeness of its substitutes, and then the commodity's importance in the buyer's budget and the number of its uses. The two other remaining elasticity concepts are income elasticity and cross elasticity. And we have seen that in case of income elasticity, you need to relate percentage change in quantity in the numerator and percentage change in the income in the denominator. So the second important area, this is about demand analysis, the crux of demand forecasting and elasticity. And that develops one important tool, demand side. Now let us develop the supply side. The background required for supply side is the theory of production and theory of cost. They give the inputs for development of supply tool, and bringing this demand and supply together, you can determine price under different types of markets. So theory of production, what do we mean by production? Production means the transformation of inputs into output. So production is simply transformation of inputs into output. If you convert inputs into output, that is called production function. So how to write a production function? Just like demand function, you can have a production function. Q here stands for output. Output is a function of inputs like A, B, C, D. These are inputs. Okay. So a note on terminology, for example, is there any difference between factors of production and inputs? There are four factors of production. We know land, labor, capital and enterprise when defined in a broader way, and labor and capital when defined in a narrow sense. They are called factors of production. And inputs are all the things purchased by the firm, not only payments to these factors. There are certain other items that are also purchased for the sake of production. They are called inputs. And what is output? All the things it sells, that is called output. So these are the simple definitions of factors of production, inputs, output. In production theory, basically we are interested in understanding three types of relations. One is what happens to output when all the inputs are held constant and only one input is varied. So if you go on increasing, say, number of workers, keeping land, manures, other fertilizers, etc. are constant, can we go on increasing output? Is there any limit for growth? So the law of variable proportions or law of diminishing marginal return says that eventually the additional productivity gradually diminishes, becomes zero, and if you continue it becomes even negative also. That is a universal human experience. Okay. And second type of relation is what happens if the firm varies two variables, labor and capital, for example, in different combinations. So we can explain the producer's equilibrium with one variable input or producer's equilibrium with two variable inputs, that is derivation or obtaining least cost combination of inputs using the modified application of indifference